we want to start today with a question via email. And this came in from Don about an hour or so ago. And Don says we have a 290, 285 October bull put on Costco, which is now in the money. The stock dropped to about 287, so it's between the two strike prices, and earnings are due on October 3rd. Now he comments, it was careless to place, but could be a good learning experience. I would like help analyzing the following. If I move the 285 put to the 15th of November 295 for a debit of about 740, it looks like, and then sell a January 2020 295 short call for a credit above 14. Now, he goes on to say, so we're going to sort of roll the bull put into a calendar spread, in a sense. And at the same time, we're going to sell a short call. And he also comments that if cost drops after earnings, I'd buy back the short call. Well, hopefully it gets some decay with you, either from the implied volatility or the decline of the stock. And receive assignment at 290 and close the married out. So we didn't mention that we had stock, so I wouldn't really call this a married put. You just have a calendar put spread, not necessarily a married put. I would appreciate your help in evaluating the efficacy of this strategy. And I have to, that didn't look good. Well, skewed on me there, but in any case, I put this together quickly. This is just the stock chart, of course, of Costco. I'm going to work on some assumptions here. I didn't get a chance to email Don back before the webinar began. But we're going to assume Don entered his bull put credit spread somewhere around here. So we would have sold the 290 and bought the 285 for our bull put spread. Okay, more like that. So we would have done it somewhere in this range, maybe even up here, but I think in this range on or around the 5th, 6th, or 7th of September, maybe even the 9th. I think we looked at the 7th. On September 7th, the net credit for that October 290, 285 was about 135, according to the historical option chain. I could have sold the short put for about 535 and bought the long 285 put, for a cost of around $4, I believe it was. Yeah, $5.35 and $4, Okay, so we're going to take a look at the PowerOptions Portfolio Tool. That's what I put this into. And then we're going to link over to the profit and loss chart to sort of take a look at what we might see as far as the adjustments that were being planned. Okay, so I'm going to leave this actually here for now. And let's go ahead and do that. Let's make sure the view changes. Okay, so what we're looking at here is the basic PowerOptions trial account. For those of you that are just getting started, make sure you take advantage of the 4 steps that are listed here. Quick start guide, go through the flash tutorials. You can view our archive webinars at any time, and of course the free coaching session, you can schedule that at any time as well. It's a 35 to 45 minute phone conversation with myself or Ernie. All right, to Don's bull put credit spread. Let's just navigate over to the portfolio, and we'll click on the main portfolio view. Here's our position. Entered on September 7th. I bought the 285 put, sold the 290. We got an initial credit of 135, and of course, as we can see, as Don mentioned, Costco is now at 268.42, closed $1.85 down today, so it's between our strike prices and getting close to our 285 long put. The liquidation value right now would be $113. Cost us $113 to close the position. So it'd be a loss of 83.3. If we hold it to expiration, we're going to lose a lot more. The time value would dissipate out of both options. So we'd have a much larger loss as opposed to that. But let's go to the profit and loss chart because Don wants to evaluate what's going to happen. Oh, sorry, folks. There we go. What is going to happen if we roll this bull put credit spread, make an adjustment here by selling to close the 285 long, which has increased in value as the stock has fallen between the strike prices, and we want to buy a further out November 295. All right, so let's take a look at this first. Let's go to our available options. I'm going to simulate closing this position. So We're going to sell to close the 285 right now for a credit of about midpoint, let's call it 755. Okay, we paid $4 for it. So what does that mean? If I buy to close just this one, I'm sorry, if I sell to close, remember we bought to open initially, doing the reverse action here, selling to close the 285, this essentially means we've got a naked put now at this point at the 290 strike with a total credit of 890. The original 535 we took in, the 755 we're getting for selling to close our 285, and $4 in premium that we had to originally pay, minus the $4 in premium we originally paid for that 285 put. Now, what I'm going to do is just take this idea, 890, that's our total credit after closing this long. We're just going to remove the extra legs, and we're going to put in that we're short. One 290 put at 890. Now let's see the cost for adding in the November 19th 295. This type, did you say November? I'm sorry, you said November, 15 November, I'm sorry. There we go, we want the 295 put. Now, remember, originally he had sold the October 290 and bought the 285. And now we're going to essentially roll this by closing this one and buying a higher strike put. If I kept the same expiration, and this was October, and I now bought this 295 for a debit, we would refer to this as the pendulum adjustment. Now, sort of more like this, but we would refer to this as the pendulum adjustment. I just swung this over to turn my bull put into a bear put debit. Okay, that's what we mean by the pendulum adjustment. We just swung this over to this strike, and now we've got a bearish position on a stock that's declining. That's what we refer to as the pendulum adjustment here at Power Options. Now, you added a twist to this. You're going out to November, so we're actually creating more of a calendar position. We've now got a November 295, 290 calendar put spread, a bearish strategy, where the stock is here, we should still be at a profit on or around October expiration. I left out the other part for a moment for a reason right now. Okay, so what did we do? We changed a credit to a debit. We keep a max profit of 426, which is higher than the bull put, but remember that max profit occurs if and only if the stock's trading right around our short put strike 290 on October expiration. Hold on one second. I want to do something here. There we go. I just want to change that up so you're not viewing all the ridiculous icons and all the unnecessary stuff underneath. I forgot I did that. Okay. So that is the first move. Now, as I mentioned, Don didn't say he owns stock, but part of his plan was that if the stock drops after earnings, which is coming out on October 3rd, okay, 15 days before we hit expiration on October 18th. Yeah, October 18th, I'm sorry. So if the stock swings down, he says, well, if it swings down, we could receive assignment at 290 and buy the 295 to cover the 290 short. So you'd get 5 points back. Part of the problem I have with that thought process is that we've now entered a calendar put spread. That if, yes, the stock collapses due to a poor earnings, you may get assigned at that 290 strike. You've rolled up to the 295, which does give you the right, if you're assigned early here at this price, they won't do it for you automatically because it's a different expiration. If this was a bear put debit, as I mentioned, where these were both October, if you got assigned early on the short and your brokerage saw you have the same expiration for a long, they might exercise this to deliver this, so you just get the 5 points back, and you wouldn't be long stock and long the 295 October put, or just leave it open through October expiration. They might exercise your put if it's still below 295. We've seen this in the past with calendar spreads. Over the past 2 years, other attendees joining us saying they were in a calendar spread and they got assigned early on the short call or the short put, but the broker did not exercise the long immediately because they were different expirations. So, okay, it falls on October 3rd from earnings, you get assigned and you have to use the 295 long. You exercise your right to cover this short. You get the 5 points back. There's another leg you mentioned, Don, and I'm not looking at that yet. My problem with just this structure, not considering the other option that you're going to sell, is that you're in a calendar put spread, which is a form of a bear put debit, that including the original price of the long option, remember we took that into account, that gave us a naked put at 890, and we just added the November 295 put at 1518, so it's a debit of about 628. The max you can get back on this, if you exercise the long now, the new long, to deliver your short if you're assigned early, is 5 points. You're immediately at a loss of 127, 128. Not bad. And yes, your other option is going to cover that. But I don't like to put myself in part of a structure that I'm using as a repair where I know that it can't make a profit if it goes down or if it swings back up. Now, you've got a true risk up here of 627, the full debit, if it really rockets up here, which could also happen from earnings. Now, again, you didn't mention to me in your email, Don, that you own stock. You'd said the married put. You mentioned married put or married out in that, but you didn't say what price you had for the stock. So I'm working on this assuming you don't own the stock. And your second leg that you were going to add was we were going to sell a 2020 January 295 call for about 14. Here's where things get tricky. So now I've got a calendar put, and I'm adding a far out, 120 days, 112 days, short call, again, also at the 295 strike. Now, I'm not going to go into my, now you said when you emailed me it was about 14. Unfortunately, you could see now that call has dropped. The 290 is at 14, probably dropped another point or two, so we're only at about $12 here. But you mentioned the 295, so I'm going to use the 295. All right, so let's sell that. Now I have a problem, don't I? I've entered a bearish position. This is a calendar put spread, which does make money if the stock falls down, but you do have a double break even, okay? The risk is to the upside. Now you're going to pay for this debit by selling this short call out to January. But you're still in what? You're still in two bearish positions, the calendar put and now a naked call, because you didn't clarify if you own the shares of stocks. Without owning shares of stock, you're in a calendar put with a naked call, which is going to require a fair amount of margin, okay? And so at the same time, we sell that. Now we're going to transfer to a credit. We get it close to that $12. So we've got about 560, 570. But now the monetary requirement jumps up. Now this structure does look more profitable to the downside. And what's the outcomes? The stock falls, let's say on October 3rd, remember 10-3, let's say it takes a nice dip. Okay, let's say it drops 20 points from where it is now, drops to 265. Not quite a 10% move, but let's say 9%, I'm sorry, 265. Let's say it drops to that price on or around October 4th. Okay, so what did we expect to happen? Well, let's plug it in. 265, 20-point drop from earnings on October 4th. We collected around $11.88 for that short call. Okay? In theory, this would drop down to 455, so you've got a profit here. Your short put, the October 290, is going to increase by about 1,600, and you may expect a gain of about 1,500 on the long. So you've got a $600 profit on this position. You see you have turned it into a bearish position. That's great. But the margin requirement is now ridiculous because you've got a naked call. This is not covered by anything, again, if you don't own the stock. It looks like a good profit to the downside. I can't argue that. It will cap out there on the max profit around 1,060 if there's a huge drop, maybe down to 200 or further, okay? But the max risk now is not what I'd ever want to see. What if Costco does the opposite? What if it gaps up? What if it goes back up to 305, 306 on October 4th? Now you're at a loss of 1,292. Twice what the new cost basis was for rolling into that calendar put spread. All right, so with just your numbers that you gave me, Don, I'm not sure if I approve of this strategy because you've essentially entered a double bear. Yes, we showed that if the stock fell significantly, almost 10%, drops down to 265, you're going to have, in theory, theoretically, be able to buy that call back, earn about $700 from the premium. You're going to have a $1,600 loss roughly, and that's just close to intrinsic value, on your 290 short put that expires in October, and you may be assigned early. Rather than exercise the long to deliver the short, you might expect just maybe to sell to close it. You might still have an extra month of time value, 30, 40, 50 cents there because it's the November. So rather than exercising it, you might sell to close it and sell to close the long stock position you're in, buy to close the short call. Now, if, however, you're in this position with the stock, remember I used September 7th as an example that you traded this bull put. I don't know if you own shares of Costco, if you own shares of Costco prior to September 7th, or if you bought them at the same time when the stock was around 304, 305. 100 shares of 303. My apologies. Let's run that again. I'll give you the benefit of 303. There we go. And now this doesn't make any sense, does it? You've got a capped upside and still a 98.3% risk to the downside. How? You're just in a calendar put with a covered call. How can you have a 98.3% risk? Because your November put can only cover the short put obligation or the long stock. It can't cover both. So if you have a drastic drop down to 265, 250, 240, think of what happened to Overstock last week. It dropped about 25%, I think, and was still continuing down. Of course, it was only a $20 stock, but it's now at $11. In any case, if you have that large of a move, either the short put is going to get assigned, as you mentioned, but you're still losing on the long shares of stock. You've got one bought put at 295 that's only covering the stock or the short put. Okay, so I don't think this is the right structure if you're in a married put. And to be honest with you, I am very concerned about this structure as you explained it, not taking in owning the stock, heading into earnings because you're banking solely on a bearish move. You might be right, but you're taking a huge risk to the upside because of the obligation of the naked call position, which is not covered by anything. The short put, long put do not cover the obligation of the short call. That's why your risk is infinite to the upside in the description you gave me with no mention of the shares of stock. When I'm heading into earnings, when I'm playing an earnings play, I typically would rather see a structure that puts me something as in this, or in a long strangle, a synthetic short straddle, synthetic long strangle. So if it does swing one way or the other, I can potentially take advantage on either side of the trade. If it stays stagnant, well, maybe I can hope to manage these and roll out if the adjustment, if the reaction to the earnings is only 1 or 2%, I may have to make an adjustment there as well. I will have to make an adjustment there as well rather than take an 80, 75% loss on that straddle or strangle that's still a week out in time. This is a major bearish bet, and it concerns me because if you're wrong, I don't know if the risks of this structure outweigh the potential gains, even though you're turning a loser into a winner right now. Okay, so that's my thoughts on the position. My other thoughts are, yes, we teach 8 ways to manage a bull put spread. You can view that video in the archives. And, when a bull put starts to go against you, you can, sort of do nothing. Number 2, you could, number 1 is do nothing. Number 2 is buy to close the short, leave the long open if you think it's going to be bearish, although that would be expensive. So I might just close the 290, leave the original 285 open going into earnings, maybe take a long call to create that strangle or straddle in this case. Number 3, of course, is you could roll the whole thing. These are a little bit out of order, but you could roll the spread down if you think it's going to recover. Liquidate this spread for a loss, and then maybe roll out to a November or December, let's say 280, 275 perhaps. But again, you'd still be open in a bull put spread going through earnings, which is something we don't want to do. the pendulum adjustment itself, you might be able to roll again by just rolling your original October put to the 295 October put, leaving your 290 short there, and you'd convert a bull put credit to a bear put. Then what happens again? You're still betting on the bearish move with an earnings coming up in 8 days or so. I don't know if I want to be directional, a bull put or a bear call or an iron condor, which is opposite of what we want to see, right? On earnings, I want something that's more of a U shape or a V shape. The iron condor is this, where I could lose in either direction if there's a significant enough move. Okay, so those are some of the ideas that you might consider as well based on your expectation. Oh, sorry, folks, hold on. So yeah, I'm not approving of the structure there in that case, going into earnings. You might want to evaluate something different. If you are extremely bearish, well, you saw what this could do. I think it takes on too much risk. I think it's a directional structure with earnings coming out in 7 to 8 days, and I don't know if that's going to be a good approach as well. Okay, all right, so those are my thoughts there on this roll. You can see it here. This is what the profit and loss chart would look like based on your expiration. Is that the structure that you want to have going into an earnings announcement within the next 7 to 8 days? I don't think so. Probably want to structure it a little bit differently. We can talk about that more later after you watch the replay of this, Don, and do some analysis there as well. As many of you know, as you're tracking any position in the portfolio, whether it be credit spread, debit spread, married put, covered call, you can link to the position analysis tool from the portfolio. So I go to position actions and I go to position analysis. And this is going to give me a breakdown of my current position, comparison of my current liquidation value to my future expiration value. In this case, it's almost very tempting to liquidate when I see a liquidation value here that's a loss rather than almost doubling the loss further out in time. But again, this does show you some potential rollout opportunities to help mitigate some of the loss that you have. And it's showing you that we could create some iron condors here by opening a bear call credit to October and get maybe another 57 cents in to help hedge some of the loss we're taking. Now again, this might be a decent rollout opportunity to help mitigate some of the losses we're currently seeing if you think the stock would recover and be trading in that range. Adding the bear call to your existing bull put that's losing, that's losing right now, the stock's not that far down, but adding the bear call now just to get a little bit more net credit to help lower some of the maximum loss perhaps, but when earnings are coming up in 8 days is not a good idea. Why? Because you're already down here. This could continue down here and still get you to the maximum loss. You only hedge the maximum loss by 57 cents. If it's a large enough movement upwards, you could now actually lose on the bear call side of this spread where it would have been a successful bull put if you stayed through it and it went up there as well. So although this rollout opportunity shows, it's not taking a look actually that earnings are coming out between now and this new expiration, and an iron condor might not be the best structure. As always, if none of you have seen this before, it's great to see things numerically. But remember, when you evaluate a rollout opportunity on your position where we do all the numbers for you, you can see the new potential return and probability and more. You could go to this menu here next to your rollout and click on Simulate Trade. And this gives you a side-by-side comparison of our original bull put position with the max return of 135. Okay, and the current return is a loss about 38%. It's down here. Don't want to be there, of course. Versus what the iron condor would be. And if it does recover, now your max profit's 184 or 58.2% on the 5-point risk. Yeah, both of them are still 5-point risk. So it's only taking the loss in one direction or the other. It does increase it, and it did lower the maximum risk from 365 to 316. But again, you can still lose both directions depending on when it runs. Okay. All right, so that's just the value of the rollout opportunities. But again, I think there are other rollout opportunities that might have been done on your position, Don. We talked about maybe just using the pendulum adjustment or maybe doing something that converts this to sort of a synthetic straddle or synthetic strangle, so if there's a swing one direction or the other. I'm concerned a little bit about the position that you mentioned, converting it to that calendar put spread and then adding the naked call. because you're doing a double bear with an infinite risk to the upside because the obligation of the naked call position. Again, you didn't mention that you own stock on that, although you did try to mention married put in your email and I wasn't sure.